Hello, this is Janice Penny, and today I'm going to show you a small apartment investment analysis. Basically, it's showing the information on purchasing a small apartment complex or unit. Or units, and this could help you decide if you want to purchase and if it would be a good investment or not. So the basic information is that there are 8 units in this apartment complex, or yes, and the rent for each one of these units is $600 with a 3% rent growth, a vacancy rate of 9%. The fixed expenses are $4,500. The variable expenses are $5,000. The reserves for replacement are $4,500. And the fixed expense growth rate is 3% with a 3% variable growth rate as well, and a 3% reserve count growth. Appreciation, the total for the holding period is 10%. So this is what we're expecting to gain during the holding period. And the appreciation total, that was the 10%. Acquisition price is $375,000 with a loan to value ratio of 80%. So the loan amount is the 375 times the 80%. So that is a so the loan amount is $300,000. The mortgage interest rate is 5% with so that'll give us so now we can calculate the loan payment, the monthly loan payment, which is, I'll do that with the payment function. And whoops, I don't want to do that. No, don't want to do that. Let's see. Uh-oh. I don't know what that is. Okay, so the payment, the rate is, I'm going to point to the 5% divided by 12. And the term is, here's the loan term is 30 years. Oops. Times 12 months in the year, and the present value of the loan amount, close parentheses. Uh-oh. So one payment monthly, long term is 30. And let's go back and try that again. So it's equal to the payment function. The rate is 5% divided by 12, and then the term is 30 years times 12 months in those years, of course. And then your loan amount is $300,000. That is 80% of the $375,000. So your loan payment monthly is $1,600 and $1,610.46, and your depreciable base is 85%. So your depreciable base is 85% of the loan amount. So that would be calculated by taking the 85% times it's actually the acquisition price. So that would equal to $318,750. Now we're going to add the cost recovery period, which is 27.5. And a cost of improvements at the time of the purchase is $6,000. Investors' tax rate on income is 33%. And tax rate on capital gain is 15%. And capital gain appreciation, and depreciation, tax rate on capital gain depreciation taken is 25%. Investors' required rate of return is 10%. And selling cost 6% for commissions. And holding period, they plan to, we're looking at a 3-year period for the holding period. Now we're going to look at potential gross income to get our before tax cash flow, our total before tax cash flow. So the first item we need to look at is the potential gross income, which you get that information by taking the 8 units times the $600, actually the $600 rent times 12. So the potential gross income for the first year is $57,600. And of course, we see that we have a 3% increase in, let's see here, rent growth has a 3% growth rate. So we take that for year 1 or for year 2. We take this amount times plus the 3% rent growth rate. And let's try that again. So this is equal to get the 3% in growth, you have to use the year one potential growth income, gross income, plus your one oops, did it again, plus the 3% growth rate, and then so it would be an increase. I don't think that's correct. Okay, let's try that again. To get the second year potential gross income, you have to multiply it by the 3%, of course, that we mentioned earlier. So we take that, the year one, and then multiply it times 1 plus the 3% rent growth rate, and then close the parentheses. And the potential gross income for year two would increase to $59,328. And we do the same thing with year three. We take the year two amount and then multiply it by 1 plus the 3% again, since it's a 3% per year, close the parentheses. And so it has a potential gross income of $61,107.84 in the third year. And then last, the vacancy. So we have a vacancy potential rate of 9%. So with now we're going to calculate the vacancy losses, which we can see that we have a vacancy rate of 9%. So we would take the this is the potential gross income minus the actually times the 9% potential vacancy rate. So we do the same with year two. We take the grow it by 3%, or actually vacancy increases by so this number times the 9%. It's not correct. My apologies, actually. To get the vacancy rate for the vacancy total rate for year two, we would take the potential gross income for year two and multiply it by the